Welcome to another weekly market insight where we try to sift through the noise to get to the signal to give you actionable advice so you can make informed decisions. Joining me today is Chris, as you have over the last month or so.
2 months.
John was actually in town today, but I'm glad I'm joined by you. I tell you, this last couple of weeks it's been a lot more difficult. There seems to be a lot more noise in the market to try to sift through to get through the signals. And I would say one of the big things that's coming up that's really going to be a tell would be the earnings slide. Eventually it's going to pop up here, which is we're moving into earnings season. Right. So what are your thoughts about this thing? I know we're early on.
Yeah, very early on, and we mentioned last time earnings season has helped pull the market out of pullbacks in the past,
yes,
well, at least the last year, and we thought maybe that could help this year too. So far it's looking good. We've seen just mainly from the banks, which they did release a lot of their loans reserves again, so they're having good earnings, and revenue seems to be in line as well.
And typically banks start out the earnings season. We got some other names that are out here. Albertson and P&G have been in the market with some of their reports that they've released.
And so they were kind of, Albertson's particularly one of the largest grocers in the nation. People were concerned that they weren't going to be able to pass on their increased prices. But their margins actually stayed pretty flat. They reduced just a little bit. They said they had some issues with distribution and trucking and gas prices. But other than that, they were able to pass on their prices pretty well.
And I know that I read in the Wall Street Journal, P&G said that they are also not having difficulty passing on their prices. So their margins should be increasing. In addition, because of their size, they almost have their own independent supply chain that they dictate. So they're not having a lot of the supply issues. I know there's still the paper towels and toilet paper and other things, but it seems they're able to push these prices on, and we're in earnings season. Is that favorable for some staples companies that really have kind of been stagnant for quite some time?
Yeah, it probably is, and those two examples actually work pretty well together, right? Because Procter & Gamble's passing on their prices to Albertsons, and Albertsons is selling it to the consumer and passing it on again. So
absolutely. And then I see CSX out there, which is a shipping company, rail. Anything that you expect from them?
Expect the same thing we heard from Union Pacific about a month ago, which is they can ship about as much as they can, and then they have a hard time unloading it off their trains.
And I know Southwest has hit the headlines, and so is Chipotle. I think I'm going to try to help add to some of its profit this today at lunch and have it delivered. That makes me hungry. So let's move on to the next slide, if we can get there, where it shows the earnings estimates.
So we don't, like we said, not a whole lot of the S&P has reported, but it's been strong in about 80% beat rate on revenue and on earnings. And if you look at a 5-year historical average, the revenue is only about 65% beat. So that's a significant beat on that 80 versus 65. And earnings, which can be manipulated a little bit by accounting, is at 75%. But we're still ahead on both of those so far.
Yeah, and usually whenever you're trying to manipulate accounting, it's got to show up some. If it's all been accounting tricks, it would start to show up at some point because you can't play those games for forever. And then if we continue on with this next slide, it shows the consensus earnings whenever it pops up here, where everyone has been talking about how high the multiples are and that it's not going to be able to get through. And then we're not seeing that on the consensus earnings. Here we go, where the S&P earnings per share, we can see the blue line. What are your thoughts on seeing this?
We did a good video in July about projecting out earnings for 2022, and since then we've had a full earnings season, now entering into a new one. So we've seen estimates come up even higher than what we had projected. We were expecting somewhere around 210 on the S&P in earnings, and if you look at that the middle blue line, it's closer to 225. So their earnings expectations from consensus have been raised.
Right, and then if we look over here, these are JP Morgan slides. We're using a lot of JP Morgan slides today. If you're ever interested, they have a great PowerPoint that they go over. I think they go over it weekly. I try to make sure that I pay attention to it at least monthly. I think it's 70, 80 pages. Go out to their website and look at JP Morgan Market Insights. This is where a lot of these information is coming from. But here's one on it showing the earnings growth. So out of that, the earnings growth has been 26%, while the multiple growth has actually been a detractor. So those high multiples that everyone was complaining about in the previous quarter, a lot of the detraction has just been a slowdown. but the earnings has grown faster than that multiple contraction. So that's why we have that 14.7% return. And then if we look at those multiples, once again, we were up above the high, and we can see that 20.31, and I think it's September, and that's pulling back a little bit. So we're now one standard deviation approximately from the average.
Right.
Interest rates are low, you would expect to be high.
So it's one standard deviation above historical forward PEs for 25 years, and like you said, that the 25-year interest rates are significantly
probably
lower.
Around 4 or 5%, and look on where we are.
We're at 1.5, 1.6.
But what I'd like to point out is just how much that multiple has come down. And we've had a little bit of choppiness in the market, but we're 1% from highs, right? So it has to be that the earnings are growing at a rapid pace. So those multiples was not really indicative of a market pullback or a market correction to solve that. The next slide, if we can get it to pop up here, that we finally do, is it's showing the relationship of PE multiples versus 1-year return and then 5-year return. And we can see that orange line shows that, hey, there's a historic trend where if the multiples are high, you expect returns to be low. Right. But that's not all the story here, right?
It's just a line of best fit and a regression. And that R squared number at the bottom is called the coefficient of determination. How much of the return is determined from PE ratios. Now, in the 1 year, you're at 4%.
So 96% of it
is decided by something else outside of PE. So that's not even worth looking at.
Right.
And when we move to a 5-year annualized return, it goes up a little bit to 40.
Actually, that is not even worth looking at, right? If you were to use the standards that they teach in statistical analysis, you might as well throw this away because it's really not telling. Now, I do think there is a general truth that it's pointing out that if everything else was equal, higher multiples mean lower returns in the future. I think that's bore out, but it doesn't mean anything individually by year, because even in that 5-year regression where you're at multiples right now, where we are at September 30th, you can see the two other examples in that data set are 15-16% compounded annualized return for 5 years. So maybe that's a great multiple to be at. So it really is not the end of the story. You can make a bear case, you can make a bull case, depending on multiples, no matter where they are. And then this next slide shows us just where that earnings per share growth is coming from. Another wonderful slide from JP Morgan. And we have 64% growth, which a lot of that, 49% of it has come from margin expansion and earnings, meaning that the companies are more lean. And I remember whenever we were going through the COVID crisis and the market sell-off, and we were calling for a V-bottom and to stay invested, actually add to investment, and especially when we get out of this, earnings are going to look fantastic in companies because they're going to be lean and they're going to be mean. And I think this is demonstrating that the profit margins of companies have actually been pretty they've gotten rid of a lot of the waste. And then the revenue is up 15%. Now there's some share count detraction, we won't get into that. But most of that has been on the profit margins for the companies. Now, I guess another statement would be like, well, it's coming off a 22% retracement. That's fair, but if you were to take that out and then divide by 2, you're still upwards of 20% growth rate over 20 and 21 on average, which is certainly above the average here in this chart. So I think things are looking good from a standpoint.
This slide it's pretty much what you've been talking about, but it probably shows it a little bit better. This is the bar closest to me here, the 12.3%, is expected margin, and including what's expected for the quarter with what's already been announced, that small portion of the S&P that's reported so far. And so with that 12.3%, that's still the third highest margin that we've seen since we've been tracking here since 2016. So margins are still very high historically, even though most of what the headlines say is margins are compressing.
Now, I know we probably wouldn't hear this from the rhetoric, but one thing that happens is when profit margins go up in a company, whether that's through technology improvement or capital investment or whatever it is, it actually ends up making its way to labor. And the reason is if you're a growing company with a high profit margin, you want to continue to invest, that means you have to actually hire people away to continue to do that. So labor share actually will benefit from higher profit margins. And we can see the profit margins on the left, but over here on the right, that's the part that I want people to pay attention to. If we go back to the 70s, and there's an inflationary component to this as well, we can see that labor share was at its highest. Now, I don't like it when people don't use a 0 for the bottom of the chart because it looks a lot more dramatic, but I understand why they're doing it here. So at 58% down to in the 52% and from 2010 to 2015. But we've had a nice move up as there is now labor shortages and there's all this new capital investment. It does seem to be finally making it to the actual worker within the companies, and I bet that we're going to see a continuation of labor share of that income or profit margins expanding going forward. And there we go. That's been putting some pressure on inflation, especially in the PMI, which is really how much does it cost to produce things. Now there is another factor that is an issue, which is how long it's taking to deliver items, especially in a Six Sigma world where you have inventory that is very lean and you just in time. Those delivery times are certainly going to have an effect, but why are we having issues in delivery times? A lot of times it's labor shortage. So it's across the board. I think what we're seeing is that what's pushing the inflationary costs a lot of times is this labor component. Going back to Albertsons and Procter & Gamble, if people have more money, they're going to be easier to, you can pass on that price increase easier. So we don't know how long this will go through, but I think that's part of the story for sure. And then if we look at core or CPI and headline CPI, I don't like to distinguish that for our clients or us because we don't get to choose the way we spend based on that. I understand why we do it for investment reasons to understand what is driving that.
Headline is energy and food.
Right.
It's the full CPI.
Full
and
CPI.
Core removes those.
Right.
They say it's a little volatile, so we want to remove the effects of that.
Right. And if you try to do that on a month-to-month basis where you remove food from your purchasing, you're not going to make it to the next month. So we can see that on average, we've been about 3.4% over the last 50 years. And since really the 90s, especially as China came up and there was a lot of wage pressure decrease, as that's rolling off, it's the first time in decades that we've seen a core or headline CPI this high. There was a point in 07 where, and earlier through the Iraq war where energy prices were very dominant, and we did see that pop over. But first time we've seen core CPI over that average. So that's certainly something to be concerned about and worried. And then people are asking, well, how do we deal with this? Should we, considering high multiples, considering the possibility of inflation, should we be looking elsewhere for investments? And if I can get the slide to pop up, you'd see that we are looking at the global marketplace. Here we go, finally. And up top right hand, United States makes up 60% of the investable assets, where emerging markets is 12, and you can see Europe, UK, about 17% together, Japan is 6%. There's not a lot of places to go, and then we don't think that that's really a place that you want to go.
The argument a lot of the times is those other places outside the U.S. are cheaper, right? Mm-hmm. They have a lower price to earnings ratio. And when you look at it, that can mean a lot of things. It can mean the growth is lower there, so people are going to pay a lower price for it. Or it could just mean it's really risky, so they're going to pay a lower price. So the risky example that gets thrown out a lot is Russia. Do you really want to own Russian stocks? It's very risky. You did want to own it because you got a good return.
This year.
We didn't, but it was a little too risky for us.
Yeah, so you down in U.S. dollars over 11%, Brazil down 18%. And if you look, it's just the U.S. has been a very steady performer, and it's been the place to go. And also in this bottom part, which is the point that I would want to make, is we got to see a narrative change on why the economies in these other countries are better suited than the U.S. for the coming just economic trends. And look at how much of the sector is in technology for the S&P 500 versus the all-cap world index, 28% versus 13%. And it's just, they are geared for a different economy from what we're going into. So we still think that the narrative says the U.S. But even if we wanted to, here's another thing that we see a lot of wholesalers state is, well, look at how long the U.S. has been outperforming the international markets for 13.9 years. That's the longest time since before. Well, why not 15? Why not 16?
They were
why
probably
not
saying
17?
it at 10 years too.
They've been saying that for years now. And I think until that narrative changes, where we start to say, you know what, Europe looks better geared for the economy that the world is now going to need, I think you're better off staying in the U.S.
You think you're going to have to see a big fundamental change? Do you think it will start showing up in technicals? We use technicals a lot for risk management. How do you view kind of fundamental there?
I absolutely would think that it would show up in technicals early on. We would see both fundamentals and technicals shifting, and we're just not seeing that. In addition, whenever we look at how correlated they are, emerging markets in EFA, 89 and 81 on correlation. Well, what does that mean? It basically means that whatever's happening in the U.S. on up and down is happening in emerging markets and,
so you're not
and international.
You're not getting a great diversification effect by investing out there.
Not at all. Maybe owning bonds, you get a little bit of diversification effect, but it's not a negative correlation. I mean, it is numerically, but it's a rounding error. There's not much difference between negative 0.19 and 0.19. It basically means there's zero correlation. So if you think of, well, if I buy, if it's sunny out and I buy suntan lotion, the price should be correlated with sun, where umbrellas would be negatively correlated. So if it rains, that's when umbrellas go, not sunshine. The bonds would be pizza. There's no correlation whatsoever. There's no relationship, and that's what we see. Because we do see bonds move up with equities. Go ahead.
I was just going to say that the bonds is probably one of the most interesting ones. We still hold bonds, of course, but we've underweight them. So we hold them. They provide a diversification effect. You can see that here. But with the fundamental view of if inflation goes up, you could see equities and bonds go down together and be very correlated.
Right, and we see some data here on the next slide. I love our technology. It's part of our pillar is integrated enabling technology. It's just not very enabling today for me on this call. So the next slide, if it pops up here, is showing the relationship of a rising interest rate environment relative to returns on equities. And we can see that while it's in the green, so less than 4%, there really is, if interest rates move up, returns on equities move up. It's after we get past 4% on the U.S. 10-year Treasury that we start to see that negative correlation. A lot of that probably has to do with still very inexpensive for companies to borrow and invest for growth, so they can continue to tap loan markets to actually outpace the 4-year. Once you start getting more and more expensive, it probably becomes more difficult. So we wouldn't be too concerned about interest rates at the moment really having a significant impact on equity returns, but there is the one exception, the one-day move, right?
You see quick repricings. Looking back a few weeks ago, equities were selling off and people were saying, well, interest rates are moving up. Well, equities have recovered and interest rates are higher than where they were when they were selling off a couple weeks ago.
And though the math is pretty clear on how the formula works, you see that drop, but what a lot of people forget is what's happening is you're using a higher discount rate, so that means going forward the growth is actually faster. So I think that's part of that effect. Now, another thing that people like to do is say, well, why don't we just do a 60-40, 40-60? Let's just be more conservative. And I think that made a lot of sense back whenever interest rates were at 6 to 8%. But let's look at what that actually would have happened. So let's go prior to COVID. So we're in February of 2020, so we haven't done any lockdowns or anything like that. And we can see the market sell-off. Now the dark blue line is a 40-60 stock portfolio, more conservative. A 60-40, typically the balanced portfolio. And then the green is the S&P 500 or an all equity. March of 2020, you do feel smarter. By owning a 40-60 portfolio, you're only down 12, 13%. Where if you're in that balance, you're down almost 20%, and the S&P is down more than 30%. And then we go just a couple of months out, so we make it to June 8th, so just one quarter, not even a quarter, and that 40-60 has already recovered. And then you look at the 60-40 right behind it, just less than a month later, it's recovered. But then days later, the S&P 500 has recovered. So that just shows you, yeah, the downside protection was a little bit better, but what upside did you give up? You can see the S&P 500 has been well ahead. So it really was, it didn't neutralize, it didn't do away with the downward draft. Everyone had a downward draft, and the recovery time really wasn't that different. And then now we have to ask ourselves, well, who cares about the diversification? We see that that over the long term, the equities are going to do better. Historically, we never know. There's always a change in the future. Are bonds a good investment as investment's sake, not just something to help provide a ballast? And this next slide shows, well, where are yields? And what are the real yields? And we got to go back to the 70s to see negative yields, negative real returns like this. Now, the 70s...
Which is the yield you're actually getting minus inflation.
Right. So their interest rate and the inflation rate was much higher, but the net difference was not that much different from right now. So we're at 2.46% negative on the real rate, where we got down to 3 and 4 in the 70s. So though the interest rate numbers are different, that net effect, or what you're losing in purchasing power, is real. And then if you're going to make the argument that PEs, sorry I touched my mic, PE multiples are high, you gotta look at bonds.
Yeah, the opportunity cost, and looking here, those big bands are 15-year ranges, and where they're actually falling right now is the blue current, and you can see they're at the highest prices, lowest yields since they've been the last 15 years.
Equities are no longer as high as they were, and bonds are still all-time high. So going there probably isn't the best bet. And what about cash? Well, this is another great example by J.P. Morgan. $100,000 in a savings account. What you would need to earn just to beat that inflation is $3,977 on $100,000 for the year. And then they got education inflation and medical care inflation, and then the current $70.
If you can get it.
If you can get it.
Not all the banks are paying $70 on that.
Yeah, Chris was just like, I wish we could get $70 on $100,000. It's just so hard to find that. But you're losing, in this example, you're losing $3,907 on that cash account. So it's not that cash isn't important. We advocate having cash accounts. It's not that bonds should be forgotten. We think that they play a good role as a ballast in the portfolio.
And you're looking at the whole portfolio.
We're looking at the whole portfolio. So there isn't a silver bullet investment. So we are trying to figure out how do we protect from the downside? How do we protect for liquidity crisis? How do we do this? And we're looking at that whole picture. So that managed cash, having the right amount of fixed income, but still favoring equities, because those other two are not going to give you any growth. So we have to go for growth on the equity side. So we're trying to mitigate all those concerns and just line up those pros and cons so that it lines up with the client's goals. So continue to stay with our themes. I think the inflation risk is high, has been proven to be a true concern. I think it's really hard to argue that all of this is just transitory, other than the very technical definition of sometime it will end. But it certainly is continuing on longer than what any of the Federal Reserve chairmen were saying, or committee were saying. We continue to favor equities over fixed income. I hope we've made that case. Continue to favor the U.S. Market. Hope we've continued to prove that case. Favoring technology sector didn't work September. But it's coming back in October. We still like that as the growth standpoint in the portfolio. We make some changes in some signal based on this, but we are more steadfast in that growth component in taxable accounts, because we don't want to just get whipsawed and have tax liability to end up in the same place that we wanted to be. So we can see here's the market for price points as of yesterday. Getting really close to that all-time high. I didn't watch the end of the market, but we could have crossed it. I'll check that later this evening whenever I'm doing my rounds of material. But we're back over that 50-day moving average. So looking good. We're certainly getting concerned on that downward trend. Nice to see it move back up over that 50-day. Hopefully we get to make some new highs and continue on to move from here. And we're getting out of that seasonality component for money supply. We've actually seen a couple of weeks that have been positive. Haven't seen that quite some time. We're getting concerned. Yield curve a little bit more flat. Let's just pay attention to that to see if we do actually need to begin positioning to be a little bit more defensive. We're going the right way now.
Speaking of the seasonality, end of October tends to be pretty strong too.
Yeah, absolutely. So then looking at our relative strength chart, if it pops up here, we've been talking about how NASDAQ has been below the S&P 500. It's still below the S&P 500. We've talked about how the dollar is above the S&P 500 on being caution. I'm betting if these trends from this week continue on, we're going to start to see that tech move back up over that dollar, back down, and we're
Same
well
with the Treasury bill, right? You warned on that last week. You didn't like how high the Treasury bill was ranking on relative strengths, but over the last week it has come down about 4 spots on the rankings.
So seeing good movements. Pretty confident about our positions. Anything you want to add?
No.
All right. Well, we really appreciate you joining us this week. If you haven't subscribed already, click down there and subscribe. If you think this is an informative video and you'd like to share it with your friends, please share it. If you want to get a hold of us, please call us at this number above, or you can go to our website and request contact. And if you like this and enjoyed the talk, please hit that like button. That helps us in the algorithm so we show up more on the right-hand side whenever you're in a YouTube browser. Thank you and have a good day.